Imagine it's 10 years from today. You're sitting on your deck, coffee in hand, and you open up an app on your phone. You see a number that's grown, not because you worked overtime and not because you got a lucky inheritance, but because today, right now, you decided to stop watching from the sidelines. The truth is, most Australians want to invest, but we're bloody terrified of doing it wrong. We're worried about the ATO, we're worried about the market crashing, and honestly, we're just overwhelmed by the sheer amount of expert advice out there. G'day everyone, I'm Luke. Welcome back to Luke Invest Australia. Today, we're cutting through the noise. I've analysed the biggest mistakes beginners make in the Aussie market, and I'm going to give you a step-by-step roadmap to go from zero to shareholder by the end of this video. We're going to talk about the ASX, the best brokers for 2026, how to handle your taxes without losing your mind, and exactly which buttons to press to buy your first stock. Whether you've got $500 or $5,000, this is the guide I wish I had when I started. Let's get stuck in. Before we talk about brokers or ETFs, we need to address the elephant in the room. Why haven't you started yet? If you're like most people, you've probably spent weeks, maybe months, falling down a YouTube rabbit hole. One person tells you to buy Tesla, another says individual stocks are gambling and you should only buy ETFs. Then someone else mentions franking credits or chess sponsorship, and you just think, you know what, I'll just leave my money in my savings account for another month while I figure this out. That, my friends, is analysis paralysis, and it is the single biggest wealth killer in Australia. While you're waiting for the perfect moment or the perfect stock, the market is moving. If I've learned anything from my years of investing, it's this. Time in the market beats timing the market every single time. In this script, we aren't looking for get-rich-quick schemes. We aren't looking for the next crypto to the moon play. We're looking for a sustainable, boring, and highly effective way to build wealth so you don't have to work until you're 80. If you can commit to being boring with your money, you're already ahead of 90% of the population. Alright, let's get into the mechanics. When we talk about the market in Australia, we're usually talking about the ASX, the Australian Securities Exchange. Think of the ASX like a giant shopping centre. Inside that centre, you've got different shops. Some shops are huge, like CBA, BHP, or Woolworths. When you buy a share, you're essentially buying a tiny piece of that shop. If the shop does well and makes a profit, your piece becomes more valuable. Simple, right? But here's the dilemma for beginners. Do you pick individual shops, or do you buy the whole shopping centre? This brings us to ETFs, exchange-traded funds. If you're starting out in 2026, I reckon ETFs are your best friend. Instead of trying to guess if Woolies is going to beat Coles this year, you buy an ETF that owns both of them, plus the banks, the miners, and the tech companies. In Australia, we have some staple ETFs that almost every beginner looks at. You've probably heard VAS, Vanguard Australian Shares, or A200, Beta Shares Australia 200. These basically track the top 200 or 300 companies in Australia. If the Aussie economy grows over 20 years, your investment grows. But don't just stay in Australia. We're a small island. You also want a piece of the global pie. That's where ETFs like VGS, International Shares, or IVV, the S&P 500, the 500 biggest companies in the US, come in. My strategy? Keep it simple. A Vegemite Portfolio. Classic, reliable, and covers the basics. You don't need 50 different stocks. You might only need 2 or 3 well-chosen ETFs to build a multi-million-dollar portfolio over time. Now, this is where it gets specific to Australia. When you sign up for a broker here, you'll hear a term thrown around, chess sponsored. No, it has nothing to do with the board game. It stands for Clearinghouse Electronic Sub-Register System. In most countries, when you buy a share, the broker holds it for you in a custodial model. It's like they're holding your car keys. But in Australia, we have this amazing thing where the shares can be registered directly in your name with the ASX. When you use a CHESS-sponsored broker, you get something called a HIN, a Holder Identification Number. This is like your digital proof of ownership. Even if your broker goes bust tomorrow, it doesn't matter. Those shares are yours, registered with the ASX in your name, and you can just move them to another broker. Is it a deal breaker if a broker isn't CHESS sponsored? Not necessarily. Some newer, cheaper apps use the custodial model. They're usually safe, but if you're like me and you want that extra peace of mind for your life savings, look for a CHESS-sponsored broker. It's the gold standard for Australian investors. So how do you actually buy the shares? You need a broker. Back in the day, you'd have to call a bloke in a suit. Now it's all on your phone. In 2026, we are spoiled for choice in Australia. Here's the breakdown of the main players. Number 1, CommSec, the big daddy, owned by CBA. It's reliable, it's CHESS-sponsored, but their fees are traditionally a bit higher. Great if you already bank with CBA and want everything in one place. Number 2, Stake, very popular with the younger crowd. They offer $3 flat brokerage for Aussie shares, and they are CHESS-sponsored. Their app is sleek and very easy to use. Number 3, Pearler. This is the long-term investor app. They have great features for auto investing, which we'll talk about in a minute. If your goal is to set and forget for 20 years, Pearler is a fantastic shout. Number 4, Moomoo. These guys have been making waves recently. They are CHESS-sponsored, they have incredibly low fees, sometimes starting at $0 for a limited time, and they give you a heap of data. When you're choosing, don't get too caught up on the $2 difference in brokerage fees. What matters more is, does the app make you feel confident, is it easy to use, and does it support the way you want to invest? If you're just starting, pick one, finish the ID check, which usually takes 5 minutes, and get your account ready. Here's a gotcha that catches every Aussie beginner. It's called the minimum marketable parcel. On the ASX, the very first time you buy a specific stock or ETF, you generally have to buy at least $500 worth. You can't just go in and buy $10 of BHP. Why? It's an ASX rule to make sure the registry isn't filled with millions of people owning 50 cents worth of shares. Once you've made that first $500 purchase, you can usually top up with smaller amounts, depending on your broker, but that first entry ticket is $500. My advice, save up $600. Why $600? Because you'll need a few dollars for the brokerage fee and you want a little buffer in case the price moves while you're typing in the order. Think of that first $500 not as spending money, but as moving money from your spending bucket to your freedom bucket. It's still your money, it's just wearing a different outfit now. So you've bought your first $500 of an ETF. What now? Do you wait for the news to tell you when to buy more? No, you automate. There's a strategy called dollar cost averaging, or DCA. It sounds fancy, but it's dead simple. You decide that on the first of every month or every payday, you're going to invest $200 or $500 or whatever you can afford. If the market is up, you buy. If the market is crashing, you buy. In fact, when the market crashes, you should be happy. It means the shopping center is having a 20% off sale. By investing the same amount regularly, you end up buying more shares when they're cheap and fewer when they're expensive. Over 10, 20, or 30 years, this is how wealth is actually built in Australia. It's not about picking the winner, it's about the discipline of showing up every month. And don't forget the Aussie bonus, franking credits. When Aussie companies pay you a dividend, they've usually already paid tax on that profit at the corporate level. To stop you from being taxed twice, the ATO gives you a credit. For many Aussie investors, this makes our stock market one of the most tax-efficient ways to build income in the world. Look, the world is always going to give you a reason to wait. There's always an election, a recession scare, or a bubble someone is talking about on the news. But remember what we said at the start. The perfect time to start was 10 years ago. The second best time is today. If you found this helpful, do me a massive favor. Hit that like button and subscribe to Luke Invest Australia. It helps the channel out a ton, and it means you won't miss our next deep dive into building wealth down under. Your homework for today, don't just close this video. Go and research one broker we mentioned. Check out one ETF like VAS or IVV. Just take one small step. I'm Luke, and I'll see you in the next video. Cheers!